Dwayne Johnson is not just a movie star, he is a multi-billion-dollar industry. For over a decade, his name alone has been a cornerstone of studio slates, a brand synonymous with global box office. But behind the red carpets and the opening weekend headlines lies a persistent, multi-film paradox. How is it that a star of this magnitude, in film after film, presides over projects that struggle to reach, or outright miss, their financial break-even point? The answer isn't about charisma or appeal. It's about a system. To understand the systemic pressures at play, we must focus on a definitive case study. For this analysis, we will examine 2022's Black Adam. The film was not merely another superhero project for Warner Brothers and its then fledgling DC studios. It was a calculated corporate bet with a singular strategic goal. The premise was high concept and tailored precisely to Johnson's brand. An anti-hero from the comics, blessed with the powers of ancient gods, is unleashed in the modern world. The financial expectation was clear. Johnson, coming off a string of franchise successes like Jumanji and the Fast and Furious series, was viewed as a proven global opener. His social media reach of hundreds of millions was seen as a built-in marketing engine. The industry calculus was that Johnson's star power could not only launch a new DC character, but also successfully pivot the entire franchise's direction, offering a darker, more formidable counterpoint to the established heroes. Internally at Warner Brothers, then under the leadership of CEO David Zaslav, the expectation was for a clean, profitable win that would validate a new, star-driven path for DC. The studio's substantial financial commitment was predicated on a belief in a reliable formula. Dwayne Johnson, plus superhero IP, plus a production budget north of $200 million, equals a box office behemoth that would cross the crucial profitability threshold and spawn a new series of films. All subsequent business decisions flowed from this foundational and, as the numbers would reveal, perilously optimistic assumption. The financial fate of a tentpole film like Black Adam is not determined by critics or opening weekend buzz. It is locked in place by a far more rigid force, the immutable math of its cost structure versus its potential revenue. To understand why this film failed to break even, we must perform a complete forensic audit of its financial ledger, line by line. Our starting point is the baseline production budget. Warner Brothers officially reported this figure at $195 million. However, in Hollywood's financial ecosystem, this publicly disclosed number is merely the cost of principal photography and core visual effects. It is the foundation upon which a much taller and more expensive structure is built. The single most significant addition to this foundation is the compensation package for the star and producer, Dwayne Johnson. For a film like Black Adam, Johnson does not simply act. Through his company, $7 Productions, he is a central producer, involved in development and creative decisions. This dual role typically commands two major streams of guaranteed, upfront income: a top-tier star salary and a separate producing fee. While the exact breakdown is confidential, the established market rate for a star of Johnson's magnitude, anchoring a film of this scale, places his total upfront compensation comfortably in the range of $20 to $25 million. This is a fixed cost, paid irrespective of the film's ultimate profitability. But the financial commitment does not end there. It is widely reported within industry circles that Johnson's deals include a significant share of a film's first dollar gross. This is a critical distinction from standard back-end profit participation. First dollar gross entitles the participant to a percentage, often cited in trade reports as being in the high single digits, of the very first revenue the studio receives from box office ticket sales. This means that for every dollar a theater sends to Warner Brothers, a portion is immediately diverted to Johnson's company before the studio applies any revenue toward its own massive expenses. This mechanism structurally elevates the film's break-even point, demanding a higher total gross before the studio itself can begin to recoup its investment. The cost structure continues to escalate from there. A film designed around the nearly indestructible, godlike powers of Black Adam required a visual effects burden commensurate with a top-tier superhero film. Every sequence of flight, every energy blast, and the rendering of the villainous Sabak represented millions of dollars in CGI work. Director Jaume Collet Serra, while a proven filmmaker in the thriller genre, was operating at an unprecedented scale with corresponding costs. The supporting cast, including established names like Pierce Brosnan and Aldous Hodge, commanded multi-million-dollar salaries. When all these elements, the VFX, the director's fee, the co-star salaries, and the myriad other production line items, are layered on top of the base budget and Johnson's compensation, the true net production cost likely approached and potentially exceeded $220 million. Then, we must account for the engine required to launch this product into the global marketplace, the marketing budget. For a studio attempting to establish a brand new superhero property with franchise aspirations, a conservative campaign is not an option. The standard industry practice is to allocate a global prints and advertising spend, roughly equivalent to the film's production budget. For Black Adam, this meant a worldwide marketing and distribution campaign estimated at approximately $100 million. Some analysts, considering the film's lengthy promotional campaign, extensive use of Johnson's social media reach, and global premiere events, believe the final P&A spend may have edged closer to $120 million. This brings the studio's total estimated investment, the money that must be recouped before any profit is realized, to a staggering range between $320 and $340 million. Now, we confront the revenue. Black Adam grossed $393 million at the worldwide box office. To the casual observer, a figure nearing $400 million suggests success, but in the studio's accounting office, this number is almost meaningless on its own. The studio's actual revenue is a fraction of this gross, determined by complex, pre-negotiated shares with theater chains across the globe. The revenue splits are non-negotiable and harsh. They are the final, decisive variable in the profitability equation. Of the film's domestic haul, the revenue from the United States and Canada, which totaled $168 million, Warner Brothers would retain a standard share of approximately 50%. This nets the studio roughly $84 million. The film's international performance, excluding China, generated $224 million. Here, the studio's share is typically lower, averaging around 40%. This yields approximately $89.6 million. In China, where the film underperformed significantly with just $5.9 million, the studio's share is a mere 25%, resulting in a negligible return of about $1.5 million. When these theater shares are tallied, the headline global box office of $393 million translated into a net theatrical revenue for Warner Brothers of just $175.1 million. The final calculation is devastating in its simplicity. To generate $175.1 million in net revenue, Warner Brothers spent an estimated $320 to $340 million. This represents a net loss from the theatrical window alone of approximately $145 to $165 million. Subsequent revenue from home entertainment, television licensing, and merchandise would only serve to offset a portion of this deep deficit. The industry's benchmark for a tentpole film to reach its break-even point is typically 2.5 times its production budget. For Black Adam, with its true net cost, this meant the film needed to generate approximately $550 million at the global box office simply to reach zero. It fell over $150 million short of that target. The system, built upon exceptionally high fixed costs and a revenue-sharing model that prioritizes the star's upfront compensation, guaranteed this financial outcome long before a single audience member bought a ticket. The colossal financial loss of Black Adam was not a surprise within the system. It was the preordained outcome of a critical structural decision made at the highest levels of both Warner Brothers and Seven Bucks Productions years before cameras rolled. That decision was to design and approve the film as a Star-Centric vehicle, whose entire economic architecture was built to accommodate and maximize the specific value and demands of Dwayne Johnson, rather than the sustainable economics of a franchise. This decision directly translated into a business model with perilously thin margins. From the outset, the film's budget was calibrated not around the cost of telling a story about the character of Black Adam, but around the cost of delivering a Dwayne Johnson superhero spectacle. This encompassed his mandatory upfront salary and producing fees, his back-end first-dollar gross participation that siphoned off initial revenue, and the high-cost, VFX-heavy action sequences required to showcase his character's power in a manner befitting his star persona. The studio's incentive was to secure Johnson's commitment at any cost, believing his brand equity was the only reliable guarantee for a new DC property. Johnson's incentive, through his company, was to maximize his own financial and creative control up front, securing his compensation irrespective of the film's final profitability. This created a fundamental misalignment. The star's financial success was contractually assured, while the studio bore the entire financial risk of the film's performance. The pressure of this model was then intensified by an external mandate: the newly merged Warner Bros. Discovery's urgent need for a hit. Under CEO David Zaslav, the studio had publicly scrapped completed films like Batgirl for tax write-offs, creating a public relations crisis and a desperate need for a demonstrable, traditional box office success. Black Adam was positioned to be that victory, placing immense pressure on the film, not just to perform, but to perform exceptionally well to justify its own cost structure and repair the studio's image. This timing pressure eliminated any possibility of scaling back the film's financial ambitions. Instead, it locked the studio into its most expensive possible path forward. The long-term strategic consequences were severe. The film's failure to break even financially meant it also failed in its core franchise-launching mission. The planned showdown between Black Adam and Superman, heavily teased in the film's marketing and post-credits scene, was abruptly canceled. The entire leadership of DC Studios was replaced, with new co-CEOs James Gunn and Peter Safran announcing a complete creative reboot that explicitly did not include Johnson's version of the character. The Star-Centric model, which had consumed over $300 million in capital, resulted in zero franchise equity for the studio. The asset generated no sequels, no spin-offs, and was rendered a narrative dead end within months of its release. The decision to build the film as a vehicle for a star, rather than a story for a universe, ultimately stranded the investment and forced a costly strategic pivot. The financial outcome of Black Adam did not vanish into the ether of Hollywood accounting. It served as a potent, data-driven catalyst for a strategic recalibration, first within Warner Bros. And then across the industry, fundamentally challenging the long-held economics of the star-driven tentpole. The most immediate consequence was the decisive end of the previous strategy at DC Studios. The film's inability to launch a franchise was the final piece of evidence for new leadership. Co-CEOs James Gunn and Peter Safran, installed after the film's release, did not merely sideline the character of Black Adam. They publicly announced a complete, centralized creative reboot. This move explicitly rejected the prior model of building a universe around isolated star vehicles with exorbitant upfront costs. The new mandate shifted focus to narrative cohesion and sustainable economics, prioritizing directors and characters over pure star power. This incident crystallized a broader, pre-existing industry trend towards fiscal restraint. Black Adam became a textbook case study in boardrooms for the perils of first-dollar gross deals in an era of compressed theatrical margins. Studios, facing pressure from shareholders and the volatile streaming market, began aggressively renegotiating the traditional star compensation package. The new model increasingly favors large upfront salaries, coupled with true back-end participation, payments contingent on the film actually turning a net profit, thereby better aligning the star's financial incentive with the studios. The blank check era for star-driven projects was over. Furthermore, the film's performance accelerated a shift in greenlight decisions. The sheer financial risk of a $200 million plus production dedicated to a single star, without the safety net of pre-sold intellectual property, is now viewed with extreme skepticism. Studios now consistently seek risk mitigation through co-financing partnerships, as seen with projects like the upcoming Red One, distributing the burden. The industry's calculus has evolved. Sustainable franchise building and intellectual property are now valued as more reliable assets than star power alone. The system adapted, concluding that a star must be a component of a profitable equation, not the sole variable defining it. The verdict on Black Adam is not about the appeal of its star or its quality as a film. The verdict is about a business model that collapsed under its own financial weight. The evidence demonstrates that the film's failure to break even was a structural inevitability, not bad luck. The system created for it, with its extreme fixed costs, premium star participation deals, and reliance on maximum global performance, established a break-even point north of $550 million. This target was mathematically improbable from the start. Therefore, Black Adam stands as a definitive case study. It proves that in the modern economic landscape of Hollywood, a film engineered primarily as a star vehicle, with costs scaled to match, creates a financial architecture where success is the exception and break-even is the struggle. The outcome was written into the contracts and the budget long before the first box office report. If this forensic breakdown of Hollywood's financial architecture was valuable to you, make sure to subscribe. Our channel is dedicated to analyzing the systems, not the gossip, behind the industry's balance sheets.